Good day everyone, I hope you're well. So our second video will be about forms of ownership. This video forms of ownership will be in two parts as it is quite a large topic and I want you to understand it completely. So firstly, forms of ownership. It says before you decide to start your own company, you need to consider the following first. There are 5 factors you need to consider. Firstly, your startup costs, the size and the nature of your business, what will you sell or provide, then the tax implications. If it's a big business or a smaller business, there will be tax implications, meaning a certain part of your income will have to go for taxes. Then the fourth one there is your management structure, how the business will be managed, and then how many people will you have that work for you, and then lastly there is the risk involved. Will your business succeed or not? Before we go into depth, there are certain terms we need to understand first. Okay, liability. When we talk about liability, it refers to the financial debt or obligation a company or that is owed by a company. So the money we need to pay back, or from tertiary institutions where we might have borrowed money. Then we get limited and unlimited liability. Limited liability talks about it's limited to the amount invested. For example, you invest 10% of your money into the business. Okay, so you only pay if there are any debts, like let's say the business go into debt and it's declared insolvent, meaning it needs to close down, or the debts needs to be paid. Only 10% of the amount, or only 10% of the debts will then be paid by you, because it is limited liability. Okay, then the next one we get is unlimited liability, meaning if you get into a business and it's unlimited liability, it means that all of the debts of that business needs to be shared. Okay, so this guy, he invested 10% of his money into the business, but unfortunately he has unlimited liability, meaning all of the debts, let's say it's 10 million rand or $10 million, it needs to be shared equally between all of the partners. Okay, then our next one, we get non-profit company versus a profit company. Let's focus on the non-profit company first. A non-profit company is established for charity purposes. So the aim for the business is not to make a profit, but to help the charity. They promote social and cultural activities like a church. If you think of a church and you give tithes or you give money to the church, they don't use it for themselves. They use it for the church or the social committee that you are obviously part of. Okay, they are not for gain, and they're also not required to pay any taxes on income. So if we take it into consideration now, a church or any cultural organization doesn't have to pay any taxes because they don't get money from the government or any places like that to help them. Okay, then we get a profit company. As you can see here in the corner, here's Mr. Krabs, and he loves money. When I think of a profit company, I think of him seeing money. The only aim for the business is to gain profit. Okay, they are established for gain. They have to pay taxes on income, and these or public companies can be referred to as a private company, a public company, a state-owned company. Okay, our very first form of ownership we will get to is a sole proprietor or a sole trader. A few characteristics of a sole trader is they don't have any legal requirements. So the name of business, it can be any name. The owner and the business are the same entity. So for those of you that have accounting, you will know that there is a business entity rule. That rule tells you that the business and the owner's entities must be kept separate. But when it is a sole proprietor or a sole trader, the business and the owner are seen as one. They maybe start without registration, and if there can be a lot of people to assist in the business, but only the owner has full control. As you can see the pictures, there's one person that has the company, or that's the owner. They don't have any registration, they don't need to register the company, and there are multiple people working for the owner. Now, unfortunately, there are good things and there are bad things, like advantages and disadvantages of having a sole trader or a sole trader business. Firstly, the advantages will be it's quick and easy to start, so you don't need a lot of capital, and the owner has full control, so he or she can make quick decisions. Now, the disadvantages is the owner has full liability. So if the owner gets into a lot of debt, he's the only one that needs to pay that debt. No one else working for him will be able to pay or needs to pay that debt. Cannot expand the business, and then no continuity. No continuity means if the owner passes away, the business will then need to be closed down because there's no one else taking over his business. Okay? The second one we get to is partnerships. Partnerships has a minimum of 2 people. You get something like a partnership agreement. It's the basis of the association between the partners. And then partners combine capital, own or borrowed capital. Then they have to also share their profit according to the partnership agreement. Okay, so I hope my pictures help you a bit. They will have an agreement. For example, let's say I get into a partnership with someone else. I would say, okay, I contribute 75% to the business, and then the other person contributes 25% to the business. Then the profit needs to be shared according to the partnership agreement. If I contributed 75% to the business, I need to get 75% of the profit. Okay? If partners combine capital, whether it's own capital or borrowed capital, if you don't know the difference, own capital is my own money, and borrowed capital is when I borrow money from a bank or a financial institution to help me set up this partnership. We combine the two, or the capital, to make it obviously one whole. Again, there are advantages and disadvantages. The first one is partners bring knowledge, skills, experience, and contacts for a better chance to succeed. Just know that not a lot of businesses have money, but they have skills or they have experience to actually help this business succeed. All partners have potential interest in the business, personal interest, meaning they don't hire someone else to work in the business for them. They work in the business themselves. Again, the disadvantages is it's difficult to raise capital because some contribute skills, some contribute money maybe, and others contribute contacts. Partners are severely liable for actions of the other partner. So let's say my partner got into debt, or he borrowed money, or she borrowed money for the business, and I didn't agree to that, and they did it. I'm still going to be liable with the partner. Unlimited liability, meaning I will be liable for the debts my partner, brought onto the company, whether it's like we have the same amount of liabilities, so we will have to pay the same amount of debt or money to pay the debts off, and then no continuity. The reason why a partnership has no continuity is if one of the partners pulls out of the contract, a whole new partnership needs to be created, a whole new agreement needs to be created, because it's not valid anymore. Okay? That's why you can see it's not open, it's no continuity. The next one for tonight, or for today, is a public company. A public company trade their shares publicly on the JSE, that is a Johannesburg Stock Exchange. That is where you can get all of your South African or your companies to buy shares from. Shares are freely transferable. I will explain that now. They need to have at least a minimum of 3 directors, and the name must end with Ltd or Limited. Okay, the first one, as you can see there's a JSE. That's most of your businesses that are actually trading their shares publicly. You will see them on the JSE, and then you can buy shares from there. So a public company shares their trades their shares online to the public. Shares are freely transferable, so if I have shares, I can give it to maybe a family member without paying any fees. It's freely transferable. 3 directors, you need 3 people to actually run your business, and then the name must end with Limited. As you can see there, Pizza Hut or Pizza Huts Ltd, if it is a public company, it must end in Ltd. Then, the good thing of having, or the advantage of having a public company, is they can raise capital through sale of trades or the sale of their shares. So if I trade my shares on the JSE, I can generate capital much easier and quicker. It is their own legal entity, which means they own their own assets, and then it must be managed by 3 competent or highly skilled directors. So the people I appoint must be very highly skilled. Then the last thing is it has disadvantages, meaning large amounts of capital is needed to start this business. And then the last one there is vulnerable to increased scrutiny from the government and public. And that's all for today. We will be doing a part 2 of forms of ownership soon. Let me know if this made sense to you.